I know, I know. Good morning. Good morning. All right, so we have the opening bell here. We're below the new day opening gap of August 20th. Relatively equal highs right here. So I'm watching that as a draw. Regular trading hours, you can see here's our opening range gap right there. That's not the best color choice now, is it? Let's do this. Okay, so previous session settlement and the opening on this candle. There's your opening range gap coming in and sending our niece off to college. And you probably hear my air conditioner, which I cranked up. And now I'm sitting underneath that vent, so it's going to be a little loud. That's the noise you're hearing, so just put up with it for a minute or two until I get my office cooled down. I'm looking at the 15-second chart. We have a small little gap right there, but that wick, constant encouragement of that, it stopped it. So that's all it technically needs to send us up into that new day opening gap again. But it's still early. I don't want to try to jump ahead and anticipate everything being just straight up. It can, but for the sake of reading price action for the first few minutes, it's important for Caleb to just know that it's not necessary for you to know right away what it's going to do. Okay, so opening range gap has been priced in. There you go, you see that there. And I'd like to see it return back into the new day opening gap, not just take the gap from yesterday's settlement to today's opening at 9:30. So we're in the beginning portion of opening range, which is the 30 minutes between 9:30 and 10 a.m. There's your new day opening gap. So you want to screenshot that volume imbalance right here. Note that, because if it's going to pop the liquidity above here, it's reasonable to anticipate it trading up into that little volume imbalance there. That's the 1 minute inefficiency that's just above that short-term high. But you want to screenshot that, as I was mentioning, the wick here. Consequent encouragement of that is this. See how I hit that there? And then we didn't even touch the upper quadrant there, so it's likely that the send is going in there. Now this would have been like, say, post 9:50. If we were in the macro time and it had done that, then I'd been like, okay, it should have no problem just running directionally right into that. I want to see, when you ever hear me say that, I want to see that it's not bias. That's providing a framework for Caleb when he watches the recordings, because he has the actual documentation of me saying it over the live chart. And when he's watching these recordings, he has the benefit of not having to have real-time data. He's watching it as it happens. So he's looking at a 15-second chart, which is what most of you watching probably don't even look at, or maybe don't have the resources to be able to do it. We have a 3-second delay on latency here. So whatever I say here, you receive it 3 seconds later. So having the this gap right here, So the buy side imbalance, sell side inefficiency. It's overlaid with a new day opening gap. But you want to screenshot that that wick right here and how it behaved and took us up into that. That is a very, very easy bread and butter type setup. So for someone that doesn't have a model, for someone that's looking for something, like what does the pattern look like? Well, there's lots of patterns. There's lots of ways to engage it. But framing it in the context that it needs to run to a new day opening gap or a new week opening gap. That is my son's model. Like that's his draw. And it has to have, hopefully, something like a relative equal high either just below it or right at it. So it's in close proximity. Ideally, the actual liquidity, if he's bullish, he's going to be looking for something that has relative equal highs below a new day opening gap or a new week opening gap that he's going to be targeting as the draw, or like the magnet draw on liquidity. And then vice versa. If he's going to go short, he'd be looking for relative equal lows that are just above a old new day opening gap or the present new day opening gap or new week opening gap. And they can be old as far as, like I said, 5 weeks back for new week opening gaps and 5 days worth for new day opening gaps. And that's the criteria I'm giving to him. Not to say that you won't find more setups because you're looking at a little bit older than 5 weeks ago new week opening gaps, because they don't get stale, if you will. As long as you're using it in the right context for sentiment reasons, it's fine. They will still show you reactions in price that you're able to take trades on. So I want to see it reach up into that daily volume imbalance, and I'll take your attention to that now. I had it divided into its quadrants. I'll show you in a moment what this is again for those that don't remember or don't take notes or don't have the luxury of having been in the previous live streams. So if you're watching it live, this is the first one. This area here, we talked about this last Tuesday before the end of the stream on August 13th, 2024's live stream. I took everyone's attention to where the real bias is on a higher time frame and where that means the market will draw to, taking everything out of the confusion of is it a buy or is it a sell. It was told to you last Tuesday the market was going to go up to these levels, and we traded into it in yesterday's session at the last hour of the day session, and then in the London session we had the market trade up into it here. It's the low of the daily volume imbalance that took your attention to last Tuesday, and we kind of talked about it yesterday as well. Traded all the way up to the upper quadrant. Look at the bodies. Okay, this is the 1 minute chart. Look at that. It closes right on the upper quadrant and leaves this portion open. So this, to me, is where I want to hold my attention. I'm not trying to pick the top, and I've been maintaining that since we started this whole series in 2024. When we started live streaming, started teaching, the higher time frame has been called higher. We haven't deviated from that. And go back and listen to the recordings and you'll see that's the truth. But here we trade up into the upper quadrant, and then we had it give us a reversal, trading back down into the low. There's liquidity resting below that, and you can see that we traded there and all the way down to today's new day opening gap, and this was formed yesterday on this basis. We scrub over here. That's this reference point here. So where we settled at 5 o'clock on Monday, August 19th, 2024, and then we started trading at 6 o'clock. So that's your new day opening gap for Tuesday. That's why it's labeled the 20th, because this gap is referencing the next trading day. So you carry it forward into price action that you watch unfold. And then there's that turn at London, gyrating around towards the low. Use the low as support, rallies up, hammers it perfectly, starts to sell off, works lower, and then right down into, look at the bodies. See what the bodies are showing? The wicks are allowed to do the damage, but this is telling you that it's using the new day opening gap as I teach it. Anytime that gap would have been there, as soon as it filled it, everybody else would have completely disregarded it. Say it's out, then throw the baby out with the bathwater, and that's flawed logic. Okay, and this is the high of that daily sell sign imbalance, buy sign efficiency on the daily chart, and we want to see it try to get up into here. Let me take your attention back to it here. Above this high, and try to get into this portion. That's the part that's still remaining open right here. So that would look like this. You want to have that high to here. You want to have that on your chart, and we'll set that up as something obnoxious, like yellow. That way it's going to stand out. And we're going to extend it to the right. And we'll divide it in half, just because I want to have that information on top of it. So here's the low of that daily volume imbalance. Watch this gap in here with the volume imbalance between these two candles right there. Watch that. So we have the low of the daily volume imbalance we talked about yesterday and mentioned in advance on the 13th of August. Here's the lower quadrant midpoint, which is consequent encroachment. In the shaded yellow area, that's the portion that has not been traded to. So we went as high as the upper quadrant here, but all of the yellow area, in my mind, I want to see, does it have the ability to try to reach for that? I'm not saying it has to go right there right now. Technicals have to support the idea, but my initial interest today, with really nothing to speak of for the economic calendar that's all exciting, but it changes tomorrow. This is what my interest is. For the remainder of the week, I want to see, do we trade into this area here? So with that, I want to go over real quick to the daily and remind you where this is. This little segment of price action right in here, we talked about this. Right here. I'll elongate that. That little segment of price action right there. That is the volume imbalance. And that was mentioned to you on the 13th of August in Tuesday's last portion of the live stream. And we divide it using this as the low, which is the open of that candle, and the close on this candle. So we're marking the difference between that close to the open of the next one. There is a wick. Let me move it over here so you can see. This wick goes as low as that right there. But we're not interested in the wick here. We're looking at the difference between the bodies here and here, because there is no connection between this candle and that candle with the body. So the only bridging or overlapping of this daily's candle to this daily's candle is the connection of the wick. And because I teach you to look at the wicks as a gap, look at it through the lens of that. So if that's the case, then we want to take that gap and break it into quadrants and watch the midpoint, which is consequent encroachment. It's not mean threshold. Mean threshold is a middle of a order block. The equilibrium price point or midpoint of a gap, whether it's a buy side imbalance, sell side efficiency, or a sell side imbalance, buy side efficiency, either or, if it's up close fair value gap or down close fair value gap, the midpoint of that is consequent encroachment. And wicks are classified the same way. I internalize them as the same thing as a gap. Just like I teach that a opening range gap, you would build that with a quadrant to breaking up over quarters, which is not quarters theory. Okay, so once you have these levels divided like that, you can anticipate what's still available. And what this is saying is this little portion of this close to that level right there, that's what's being highlighted over here on the right hand side. So that is the unfilled portion of all of this move. The blue line, which you see over here, this blue line there, watch when I highlight it. The coordinates for that is 19,868 and a quarter. That's this candle's low. See, look at this value right here, up here in the left chart, right there underneath my, or above my cursor. That is the 19,868 and a quarter level. So that is the high of this CIBI down to this candle's high. So between this candle's high and that candle's low, this is a sell side imbalance, buy side inefficiency. We would expect in the future the market would reach up into that level and tap it. And we're working that level now. So I want to see, do we have the ability to grind into this more and explore this area, which has not been able to book any price above the upper quadrant of this daily volume imbalance. Okay, so that's the business there. We're again watching on a 1 minute chart. There. And this was the opening range gap. That means it's the difference at the regular trading hours. So it'd be here when that candle's close to that candle's open. Just eyeballing it. I'm going to drop that on there. But that's what you're measuring. And then we went above it here and we went back down into it as support. And now we're rallying up. So we want to see it eat into all of this. We want to see, does it have the strength and the ability with speed to be able to get to the lowest quadrant, which is this level here, of this daily volume imbalance, with the expectation that we're focusing on whether or not the market has an interest to get up to here. We know that there's an inefficiency still there because it's only delivered price down, but we've gone as far as this level here to the upside. So there's inefficiency between this level here on the left to here with buy side delivery, meaning all we're saying in simplest terms is we're expecting the market to go up in here and just offer price at these levels. And whether it stays there or continues, it's not important at this moment for Caleb. It's just that that's what we would anticipate as a realistic, it's practical, that it's gone as far as here. So if it's bullish, it's reasonable to anticipate it reaching into here. It need not do it today. Watch this one in here. Now, if you look at it over here on the 1 minute chart, we had this fair value gap there. And I like the fact that this gap occurs and forms on the 15-second chart. I see it forming on the upper half of this gap. So let me draw it out here. And we'll do it just a little bit different color, like that. Okay, so it's a little bit of a contrast. It's probably not the best color choice, is it now? This fair value gap here, if it's going to be the ideal scenario, it would be being sensitive at the high end of it. In other words, half of it. The best formations or continuation would occur where price only going into the upper half, not digging down into the bottom half. But can it do it? Yes. You go back and listen to the lectures. It's completely permissible. It's not something that it doesn't change the underlying directional bias. It doesn't change the directional impact of using these things. It just means that it's better for it to leave it open. If it leaves it open, it's indicating that it's extremely strong and it should keep pressing higher. But if it's going to go down and completely overlap that little gap on the 1 minute chart, how far can it color outside the lines? If it's going to overshoot this, how far can it go past? If it's just going to be a wick, what keeps it still germane to the idea that we would stick to reaching for this lower quadrant and measure it? Does it have the ability to get there? Number one. Two, how fast does it get there? And once it gets to that level, how does it behave? Does it hit it and fall short of going any further, or does it go through it like a hot knife through butter and just slice right on through and reach for the midpoint, which is this level here? You're weighing out all these PD arrays. If it's going to overshoot this fair value gap, this wick right here, we were talking about this yesterday over live price action. I'm going to have to turn that air conditioner off because I know it's probably annoying, and that's annoying me. So we hit the upper quadrant, but it hit the consequent approach of that wick. See it? It's perfect. It's perfect delivery. Perfect. So if you have that and you run up to this quadrant here, you want to screenshot that. Don't use my charts. Do it with your own. And you're seeing the measurement of real order flow. No depth of market needed, no ladders, no level 2 data, no nothing. Just watching price action. It should behave in a manner that supports price, repricing down to inefficiencies, using the hourly, I'm sorry, not the hourly, 1 hour chart, good grief, the 1 minute chart to the left, and carrying it over to the 15-second here. So what I'm doing is I'm constantly balancing the effects of where price should gravitate to, where it should support price, where it's allowed to do the damage. If you look at what was shown here, I was outlining the fair value gap with the focus on that lower quadrant level right there. So we were looking initially at this gap here. I told you to watch that. We went outside of it a little bit, and where to go? Just to the low of the new day opening gap, and stopped dead in its tracks and rallied up. Spent a little bit of time, and the bodies were telling you what it wants to do. It's going to want to rally. It rallies. It gives you displacement with the 1 minute chart here. So there's a gap. So that gap is real in this range from that candle's high and that candle's low. But over here on the 15-second, I took your attention there. Look where the bodies of the candles in the 15-second stop and stay inside of. It respects its fair value gap that's in the blue. You see that? Look at that. Look at that body right there. The wick is only afforded to go as low as what this 1 minute fair value gap does, and as low as the consequent encroachment of this wick. Why am I picking this wick? Because it's the highest going to the left. It went above this one. And by having that back on the chart again, there's the trade to consequent encroachment right here. So now we want to see, does it have the ability to get to the upper quadrant? So if I measure this again from here to here, that's perfect delivery. So when you're watching things and you're looking for price to, if it's going to go up, you want to be measuring as I'm teaching you here. This is the price delivery continuum theory. It's my way of reading real order flow. You don't need to know how many contracts are floating above or below, because you don't know if those orders are going to stay in the marketplace. They can be pulled. Okay, it's called spoofing. You're not going to spoof your open, high, low, and close of the intervals of the chart you're watching. Okay, that doesn't, actually, that's a mark-to-market book of where price has actually traded. These levels that are above or below ladders and depth of market on the DOM, they are not traded to. They're just flashing there until price goes there and engages it. And then you see the actual volume that was booked at that time using time and sales. Again, you're looking at what already happened. What I'm doing is I'm getting a measurement. Do we see things in price action that are going to support the algorithm repricing back to these reference points like we have here? And then does it deliver higher? Yes. Does it go to the level here, which is the lowest quadrant? Yes. And then once we got there, did it show a willingness to want to trade to consequent encroachment, which is this next level here? It trades right to it. Now we went to this objective. As we hit that, you want to screenshot all of this. You want to have all of these reference points shown, because this is exactly what Caleb's model is going to look like for him. All you're doing is framing, okay, the market has proven it gapped lower. We gapped lower. Then we overtook that gap. We traded above, used a new day opening gap here, touched the high of the opening gap here, rallied, and then we got this fair value gap given to you on a 15-second chart, but allowing you to use as much as a wick coming down to fill in this 1 minute fair value gap. But using the wicks as I've been teaching you, the consequent encroachment of that wick here is exactly that low. So there's no reason for you to be panicked. Was there any sense of urgency in my voice? Did you hear any kind of shaking? Was I nervous about it not potentially doing what I've outlined? No. It's the same boring stuff. All you're doing is relaxing and looking for the things that I'm teaching you exist in price. Because the market is algorithmic, it's going to follow the scripts. It has absolutely no bearing on how many contracts are bought or sold. It has nothing to do with it. So when you relax and start looking at what price is showing you, is it indicative of reaching to the next objective? And in the beginning, Caleb, it's not important for you to know the straight shot that takes you up in here. All we're saying is there's a big magnet, okay? There's a big magnet that is luring price up to these levels because there's an inefficiency. It's lacking up delivery, buy side delivery, movement up into these levels. It's not important for you to pick the determination of it getting to just a halfway point. It needs to just touch the low of it. And then you watch and see, does it have the ability to aggressively run into the halfway point of the opening range that's still there? Not opening range that we're trading like 9:30-10. I shouldn't have said that. As I said, I didn't realize I shouldn't use those terms. But this portion is still open and exposed to inefficiency because it's lacking candlesticks offering price as it passes through the low end of that yellow shaded area to the high end of it. So all we're doing is think of it like this. The algorithm is likely to cast price into this area to offer traders to distribute long positions or enter short positions. It's not at a point of knowing how many contracts are floating in that area. So like a thing like a book map or something similar to that effect is really not all that important, because inside of inefficiencies, the element of delivery of price is to say it's been given the opportunity to trade there. It matters not how much volume is expected to be filled with lofty levels of, okay, there's a book map reading or something, to that effect. I'm not beating up on book map. Like I said before, I personally don't need it. Students that understand what I'm teaching don't need it. If it would have been available to me when I first started, it would have helped me. It would have given me a visual representation of what orders are sitting where. It didn't make sense to me when I was first learning, and just like it probably doesn't make sense for you, but I don't have those types of tools while I'm talking to you. I don't look at that stuff. I just look at where price has shown inefficiencies, as I've been doing in the live streams. I've been showing you where the liquidity is, the buy side, the sell side, and I'm showing you how to use these higher time frame reference points as draws on liquidity to complement things that would otherwise been factored into the marketplace and analysis concepts that my son would be expected to use. So by seeing these points of reference and watching how price delivers over a 1-minute chart and a 15-second chart, when you screenshot this and it hits these levels here, and then because we took this high out here, I mentioned this in previous live streams, every time you're holding an idea that it wants to go higher and you're trading on that idea, if you have a short-term high and it reaches to a level and it goes above it, you need to be taking some kind of a partial above that. Because if you don't do that, you're going to miss the opportunity of distributing at premium level prices. And we went all the way back down into that fair value gap here on the 15-second chart and the 1-minute chart. Is it done? Is it done all the way down here? Is it completely said I'm not going to go any higher? You wait and see. You have to submit yourself and watch. Is it done? You don't know. And you have to log that time. When it created this short-term high here and trades above it, if you have the ability to take partials off, you take a partial there. But why would you want to do that, ICT? If you think it's going to go up here, what you think while you're learning and why my son's learning doesn't equate to what the market's going to do. You're discovering and gleaning experience as you watch and study and learn. You don't have everything at your disposal in terms of experience when you first start using the information. If you did, you wouldn't be watching my live streams, would you? You'd just be out there doing your own thing. So it's important to know how to run down equity, which is what I call it when we're in a buy program and we're looking for targets to be reached. Anytime it creates a short-term high and then breaks above that short-term high and you have the ability to take a partial, you should. Because it will reward you for holding on to the trade. It's a logical level to take a partial. Every single partial, listen, this is a really important fact. Go into your notes, okay? When it comes to taking partials or taking partial profits, when you're long, every short-term high that is broken, as I'm indicating here, that is a candidate for you to take a partial. It's better for you to take a partial than it is for you to move your stop loss. It's real important for you not to try to move your stop loss in the early stages of your development because you think it's productive for you to lock in profit. But the only thing you're actually doing is you're increasing the level of uncertainty, anxiety, and you're going to be worrying about your stop loss getting hit versus watching and studying whether the price is still giving you the indications that it's going to still pan out to what you thought was likely to occur before you put the trade on in the beginning. I just realized I didn't do a sound check. Let me see if I can pull up I don't have my headphones with me. I'm really unorganized this morning, but that's okay. That's okay. Let's see here. I got a lot of comments from the post I put on. I just want to hear something real quick. Audio check. Audio check. Okay, that's good. It's not bad. It's about 4 seconds delay. But we fell just short of the upper third quadrant. We swept the high here with that high, and then slipped back down into the 1 minute buy side and balance sell side efficiency, that fair value gap, and then touched that 15-second fair value gap there, right to the tick. And now we're just banging around between the lower quadrant of that daily volume imbalance, that shaded area here. It's in pink. It goes as high as this and as low as that. So you can see right away, you can see how this is a whole lot of stuff to manage on a chart, which in my mind, it's a lot easier to manage if you have the levels, the values itself on a notepad. So I'm constantly referring back to where we are in reference to these levels. And when I was younger, I used to work with graph paper, and I would have these levels written out on a piece of graph paper, and then wherever we opened up at, I would put I would draw like a a dot representing where the opening price is. And every 15 minutes, I would note where the highest high and the lowest low in reference to that. So what I was teaching myself was, if I can use the information while I was driving, okay, I'm driving in a Suzu cargo step van with candy and snacks and whatever junk food in the back of it because I was working as a vendor. I would fill these machines up on my job. So I was trying to visualize what the intraday charts were doing using my quote track, which was simply giving me the numeric value of what the market has done today. And I would note the initial highs and initial lows. So every time we made a higher high, I would track that. And it would give me a visual representation. Though I didn't have a live chart in front of me because we didn't have the ability to have that then, but I was getting real-time quotes. So it was allowing me to draw out whatever market I was working with a piece of graph paper. So it gave me a reference point of, okay, I know it made this high here, and it made a higher high, and I would write down the rough time, like if it was 10:15, 10 o'clock, 11:15, 1 o'clock in the afternoon, something to that effect. I would have a reference point. So it was a very crude way of referencing and mapping what price has done and where certain highs were and where certain lows were. And I was seeing, by doing that with the graph paper, it would create these relative equal highs and relative equal lows. And eventually, if I'm long or I'm bullish, I would want to see these things plow through it. Like we have these relative equal highs here, but we're having all this consolidation. So I would demand that it wants to reach up here aggressively and trade into here, not spend a whole lot of time in this stuff. But there's been opportunity here this morning for you to capture, screenshot where setups were formed using the gap closure here, trading above, come back down, use the gap as support. Because if the opening range gap, which is this, I'm going to put it on the close of that candle. So I'm looking up there at 19,850 and a quarter. So that's that price. This opening range gap, which again is the difference between previous day's settlement and where we open at 9:30, that range, you want to keep it on your chart. Extend it throughout the day because it will use those levels, the high, the low, and its quadrant levels. They will be used over and over and over again. Every time price is allowed to trade through it and back to it, they'll reference it. The algorithm will refer back to those levels again. But we want to see days do these types of things where if we expect prices to trade higher, we want to see the opening range gap. If it gaps lower, that's to entice traders to be short. Then you see the gap fill, which is generally what you expect to see. At the very minimum, highest probability is if you get a gap lower opening, mark out 50% of that. Because if you can capture that as a run on price, you can do a lot of bread butter trade setups like that and have no bias. You don't even need to be right on the bias because there's such a high degree of the market returning back to the middle of the gap, whatever the gap opening is at 9:30's opening bell. If there's a gap lower in relative terms to what we saw in the previous day settlement, which is this candle here, at 4:15 regular trading hours, look down here in the up lower right hand corner, you see that? If there's a large gap down like that, mark out the midpoint. Use a Fibonacci to simply do that. And then wherever that midpoint is, where we opened, it's going to gravitate to that. Even if it goes lower, it's going to go back to that midpoint. I promise you that is one of the surest things in trading. It's such a strong, it's really strong. It gives you an opportunity to be a part of a setup that is many times ignored because everybody knows about gaps. Okay, yes. And they want to see the gap close. Well, there are times when the gap doesn't close and it only goes back to halfway and then it just rockets in the direction of the gap. And it only gives you the opportunity to see fluctuations to half of the gap being filled in. But apart from that, if the gap can close and we're bullish, we want to see it leave the gap like it does here. And then come back down, look at the bodies. Look at that, stopping right at the high of the opening range gap. So that opening range of that gap, it's stopping, the wicks are going inside, this body opens, and then we send it back above. What's in close proximity to the high end of that opening range gap? It's the new day opening gap for today that was formed between the difference at settlement at 5 p.m. yesterday evening, New York local time, to the opening again at 6 p.m. So 1 hour pause in trading. We annotate that. Well, we're working off that. This candlestick comes right down to the low of it and sends us again higher. We were using the reference points on the 1 minute chart here. Came down, we saw the wick come down to the consequent correction of this highest wick here, midpoint of that. So if it's going to overshoot this fair value gap, you can determine just how far it can do that. If you watched what I was doing in recorded sessions, or when I was doing the Twitter, when I was calling out the moves 1 minute candle at a time, and I'd say, okay, what you just saw was a Mohawk where it just goes just outside the fair value gap. That's permissible price action. But when it's trading down like that and it's a bearish candle, it's scary because you're thinking, oh, it's going to fail. But you have to have a framework in measuring where is it reasonable. It can still move in the direction you think the trade's going to go. But how do you hold on to it, ICT? How do you not get scared or shaken out of it? Well, it needs to occur with things like this where we can measure it. And so by having these wicks, or if there was a larger inefficiency that I wanted to trade down into, that's what makes me confident when I'm saying this is going to be a Mohawk, okay? And I've done it live. I've done it live with my private students. I've done it live over Twitter Spaces, calling every individual candlestick. But when we start seeing these things and it starts promoting higher prices, we each time measure what the lower time frame, like we're using the 15-second chart here, all of this in here reaching up to lower quadrant, midpoint, we rally a little bit, but then we have these little tiny little fleeting attempts to try to get up to where we're aiming for. And then we slip lower, sell side, went down, we cross back over top the new day opening gap. We're inside of that opening range gap again. I want to put the quadrants on this so we can see what we're looking at in that perspective. So there's the quadrants inside of that opening range gap. I'm going to take this fair value gap off because there's a whole lot of stuff going on right now, and I'll make reference to it should we need to see it again. But you want to have these levels on your chart while you're screen capturing and logging. So here's the 15-second time on the right hand side and the 1 minute chart over here. Do we come back out of the shaded area here in gray, which is the opening range gap? And if we do, does it react off the new day opening gap in here? So this is the next draw. If it wants to retrace, we have a sell side imbalance, buy side inefficiency here, which is overlapping with the new day opening gap. Remember, we're closing the session at 10:30. I mentioned this yesterday because I want the sessions to be smaller so that way my son can digest them. They're too much. There's too many hours in each one each night when he's done working. He only has so much time because he does 12-hour shifts. Some of you are like, thank you. Weak sauce. Come on, ICT, do 8-hour sessions. So we have low of day liquidity resting right below here. And then inside that we have all these little pockets of inefficiency and relative equal lows right here. So we have a little bit of sell side there after we had that big pump up in the last 15 minutes or so of the day session yesterday. We gapped down, pumped it up one more time, that inefficiency that's remaining above here, that has been placed on the back burner for right now. And we're studying how we're behaving inside of that opening range from yesterday's previous day's settlement at 4:15 Eastern Standard Time. And then we have the opening price today at the opening bell at 9:30. We rallied up. We worked the top of that opening range gap here and touched what level? The new day opening gap low. And now we want to see it work below this low here and probe and see what any interest at all below that after that sell side's engaged. Now, if you look at what we were outlining over here and how we were running up to the lower quadrant, and then reaching up to this level here, all of this is distribution around the target we are looking for, which is midpoint of the volume balance on the daily chart, which is that low to that high. Then it slipped lower. By having partials taken off here, it doesn't matter if it does this because Caleb would have already distributed his long position. And he would have had booked profit up here at the premium levels near the highs. And when it's down here like this, it's very, very comforting to know that even if you're wrong about where you think it's going to get to ultimately, by distributing your position, as I'm teaching with running down equity, and my students know this is not just form fitted for the sake of the live stream. I actually taught this in mentorship. That element, we already tapped that low. We want to see a little bit of an expansion in here, see if it has any interest to dig down in, make an attempt to get down below yesterday's afternoon session rally here. The trade idea for my son, his trade would be completed as soon as it hit the consequent encouragement level, and then he'd have to watch and observe, does it go there? That's the graduated example of going in, having a model, reaching for a target, but not requiring that target to be hit to be finding profitable exits for your trades. That's a huge paradigm shift. When you can take your time and spend it more economically, so that way you're not in a state of panic or fear while you're engaging price, which makes it makes learning hell when it's like that. But when it's disarming and relaxed like we're doing here, nobody's pressing any buttons, nobody's saying it has to do this, nobody says it has to do that. It frees you up to watch what price is doing, so that way you can recognize certain aspects of pattern and pattern formation, so that way it leads to pattern recognition, because repetition will provide the recognition. Before you can recognize it, you got to see it multiple times. That means you have to expose yourself to what? Watching price action. And it has to meander around without you making or losing anything. And by doing that, it teaches you to key up on the things that make sense to you. What your eye sees as an opportunity isn't going to be the same thing that I see. That other people watching the same live stream, they're not going to see the same thing either. It doesn't mean that you're going to have an unprofitable model. We are not all going to have the collective opinion about watching price action. We might think it's bullish or bearish generally for the day, but I have traders that are going long and short in the same day, and they're both profitable, and they're trading at different times of the day using different models. And it sounds like it shouldn't be possible, like everybody should be doing the same thing, and that's not true, because I've given the tools for you to make this your own. You go in, you plug in what you're trying to trade on. For some of you, for example, let's cover real quick as prices chop around. I mentioned how when we opened down here and we had the gap, as soon as you see where we settled yesterday and you're watching real-time price action before I actually got on the live stream, you knew we were going to open lower than that. So we're going to have a gap lower opening. So you wait for the first tick. As soon as you drop your fib on that, you know that 834 is midpoint. That's the consequent encroachment of the opening range gap. So you could look for a retracement right in there. And I've done many times this very trade where I don't even look for anything except for as soon as it starts opening and trading, if I have range between where it's at when I first see it and where the midpoint of the gap is, I'll go long right there. Most of you would be scared shitless to do that. But I know that this math that is always likely to see that midpoint gap traded to. Because if it's going to go lower, if it's going to go lower, it's going to do this: halfway, then drop, or halfway, a little bit more, failure to close in, then drop. But if it's going to be bullish and we're expecting things up here, as outlined yesterday and last Tuesday, then means that we're anticipating the likelihood that it wants to go above the gap, and then when we see that, then it touches it here. So a gap is going to be used as a future point of reference for the algo to start keying off of and start spooling. So if it's bullish, higher time frame, and we're expecting higher prices, and we have something up here that needs to be revisited in a perfect world for efficiency, then this is going to act just like an old fair value gap. It's going to find support there. And do we see signatures that support that? Yes, the bodies are saying, I'm not interested in going back down in there, even though we had wicks doing it. And then we see price displace again, and it supports around what? The new day opening gap. And you see that element of price delivery over here. Meandering around, displacement, dropping back down, perfect delivery to new day opening gap, rally, fair value gap, boom. That right there is institutional order flow entry drill. Here's your fair value gap. All you gotta do is use that candlestick plus one tick. You would be filled there. Rallies. This is the high watermark of the daily sell side imbalance, buy side inefficiency, where the gap is on the daily chart. That was your first objective before you get to the volume imbalance, which is the pink shaded area here. And then we rallied up, hit that low, dug in, back down in, order block there. Rallies, almost immediate rebalance on that candlestick. I would have been expecting that. If I was just watching price, I would have expected that to happen. It didn't deliver there. That's fine. The fact that it didn't do it, is that good or bad? It's good. That means it left a portion open. So what's going to reach for it? That lower quadrant we were aiming for. Does it have the ability to trade there? Does it do it with speed? Yes. Then if it does, and it has those things, if it has speed, if it has a real desire to get there, that means then we should have no problem getting to the midpoint, which is there. And what does it do? It trades right to it. We have a little bit of retracement, and then pump it up one more time. Short-term high after the target's being reached. Every milestone, by having predetermined levels of what you think is a minor target. Minor targets are initial candidates. If it can trade there and you can afford yourself a partial, you would be doing it anyway. Here, if you didn't take a partial here and it rallies above that short-term high, you better be taking something off. Because in your limited experience, you're not going to know when it's going to do things like this. And if you don't take the partial profits, you're going to be seeing a winning trade turn against you, which is the reason why I preach and teach that taking partials is a professional mindset. It's not someone that doesn't hold on to their trade. It doesn't mean that you're weak. It doesn't mean that you don't have convictions, or you open the trade up with the XYZ amount of risk. Why would you want to take trade partials off when you started the trade? Fuck when I started trading. Fuck that. You're trying to make money. You're trying to make money. You don't know in the beginning of your development when your trades are on side. You don't know that. You only know that when you get out of the trade and it was profitable. But while you're watching it, you have all these things swirling around. And these dollar menu mentorship people all around the world that try to give you these little tidbits, they think they're instilling some wisdom in you, and they're really giving you bullshit. You have to take partials. You have to. Because you don't know what you don't know. You don't have the experience. And what matters more, being right or constantly making fucking money? Constantly making fucking money. But social media says you have to be right, or it don't matter. It's cap unless you're right. You didn't get to your target. Who gives a fuck that you made 17,000 real dollars? You didn't get to your target. You suck. That's the mentality. That's what the measurement stick is. They have to be right. Their thing has to be perfect. It has to go to your targets. Your logic has to be, convincing to the degree that where you got in, where you're hoping to get out at, it has to do that. But what happens if it doesn't? What happens if you're watching price and you're seeing signs that it's petering out a little bit? It's not finding the ability to climb up to that next level or threshold of objectives. Do you close the trade in panic? Do you close it in panic here? Have you controlled the risk too far by putting your stop loss below a low like that, where it's asking to get knocked out? So I teach my students, and I'm teaching my children, to think about taking partials before moving your stop loss. Because number one, it rewards you for doing the right things. You've held on to the trade to that point. You have a profitable partial. That means if you put your stop loss to cover costs at that point, theoretically, you don't have any chance of losing money. That's a huge paradigm shift for someone that's developing as a trader. You don't know what that feels like until you get there. So there's a little bit of a spike below that. So I want to see, do we maintain that or come right back up in the range between this high and what we've seen here by taking the liquidity below there. That was a little too shallow. I like that run there. That was a little bit better. So if we start losing some ground below here, we might be interested in seeing this area over here because it's a lot of liquidity resting there. But listening to folks say partials are stupid because when you first start the trade, you take on a certain measure of risk. Okay, but when I put a trade on, I'm not looking to hold on to that same measure of risk. The initial stop loss isn't going to be there as the trade progresses in my favor. Like I have protocols that tells me when I'm going to move my stop, and it isn't always moving it to a level that would always stop me out prematurely. If I'm trying to be aggressive about something and I'm going to be trading all day, that means I'm buying and selling up, down, all day long, I will be a little bit more aggressive about moving my stop loss there because I know that I'm going to be taking another trade. And it may be going against this trade's direction. I'm going to be trading back and forth, back and forth. That's a higher form of trading, and that's something that's going to take you a decade or more to get to, where you're just buying and selling, and you have a flexible, you're just trading price action. You're not going to be able to do that in a couple of years. Okay, I promise you that. And anybody tells you they can, and they've done it in like 6 months, and nobody taught them how to do it, but they're using my language, they're using my vernacular. They're bullshit. But long and short of it is, you want to be able to graduate and not have to have everything laid out like I'm only going to work in one bias. But you have to have a framework or a structure in the beginning, because otherwise, how can you measure your progress? But when you really understand what you're doing, and you understand what price is doing, and you understand how you can be biasless, you simply go out there and you're trading price based on what time of day it is and what it's reaching for. Then you're literally liquid, where you're just going in, you're taking every possible scenario and weighing out if that's a trade for you at the moment. And you don't have to take every single one of them. But over time, you'll see that you can be buying and selling, making 10, 15, 20 handles down, 10, 15, 20 handles up, 10, 15, back and forth, back and forth. And you can do 100, 150 handles, 200 handles in a day, going back and forth. And you can afford to have 2 or 3 losing trades, get stopped out, go break even, cover some costs, lose commission only, and still have, triple digit handle runs or triple digit pips in a day. But the market you're trading has to have the ability to have that measure of volatility and not just be wonky back and forth, aimless price delivery where it's better for you to say, it's not really doing that. It's a day for me to take one trade and be done. Maybe take one in the morning, one in the afternoon, and be done. Or maybe take one, get the afternoon reversal, some kind of a lunchtime macro, and then be done. But having the flexibility and the freedom to go in and trade, without a bias, that's going to be the highest form of you and your understanding in trading. But I teach it. I'm teaching my children with the lectures that I put out for them to at least start there. Okay. So it is approaching 10:30. I promised my son and all of you that we would try to keep these things to a little bit more manageable time frame. I like the idea of still getting up here. That may demand an afternoon or tomorrow framework to do that. I don't know what we're going to see in the afternoon right now based on what we're seeing, because it's a rather quiet news day. I'm not abandoning, let's say it that way. I'm not abandoning trading up into here for today. I think that there's a lot of buy side resting here. They set a lot of folks in motion that maybe we topped, and the liquidity sitting right here, and I'll just note it so it's on my chart next time we see each other. This is the buy side, and I outlined today live with you the morning run, where the liquidity would go, and what the price delivery continuum theory would show what, using a 1 minute chart, how far it can go outside the realm of a fair value gap, color outside the lines with the wicks, and where the entry models would be. And that's undeniable. You can't argue that. It's been shown to you. Make this blue. I think we're done. All right, so that buy side, everything that was outlined all through here with the 15-second and 1 minute chart, PD arrays, and where it reached up to the lower quadrant and the consequent encroachment. Go back and look at your charts and your examples of when you would expect a certain level to be draw on liquidity. Again, as a reminder in closing, you do not need that draw on liquidity to be reached by price. That doesn't equate to success. Success is measured by where you can see a beginning point where price can move from up to that terminus. And if you can frame a setup that allows you to have 15, 20 handles, then in my definition, that is a high probability likelihood that Caleb can take that trade. So it's not a guarantee you're going to be profitable in it, but it's a green light that you can take it. And all you do is simply look for inefficiencies, because his model is gaps. And he's looking for inefficiencies in price action, gravitating and keying off of new day opening gaps, new week opening gaps, and bringing in the higher time frame as we were talking about yesterday. It's not just simply intraday charts. So we're looking at elements that are found on the weekly and daily chart. And we'll be segueing more into that next week when we're looking at how to hold on to trades better. I touched on that today a little bit just to kind of get your appetite wet. But focus right here going into lunch, okay? Right down here. Very below these relative equal lows. And that's going to be it for today. Hopefully you found this insightful. And until I talk to you tomorrow, Lord willing, be safe.